Why does inflation make stocks go down? And does it affect different kind of types of stock differently?
Yeah. So the big theory behind inflation making stocks go down, first of all, understand that it doesn't always make stocks go down. It's really high inflation or quick inflation that makes stocks go down. So it's the acceleration of inflation that has the biggest impact. I saw a big study. It's really fascinating. So, and that's kind of what we've had here, right? We've had this inflation that's gone up very quickly. It's a little bit, of a weird scenario because we have this pandemic, right? This isn't a normal inflationary cycle. It could be partially temporary. They could figure out some of the supply chain constraints, so we'll see how that plays out. But a high, fast growing inflation creates problems for stocks. But overall, the concept of inflation is an issue for stocks because of what the Federal Reserve does to fight it. So the Federal Reserve sees inflations. They have two mandates, kind of trying to create full employment and then trying to keep inflation low. And the idea behind keeping inflation low, it allows companies a better chance to kind of plan, with their expansions and different things like that. When inflation is, 1.5 to 2.5%, companies are a lot more comfortable in their planning environment. When inflation's at 7 and 10 and moving all over the place, it gets to be really difficult to figure out your projects. And so the Federal Reserve comes in and they start tightening up. And they tighten up in three different ways right now. One, they're cutting back on their stimulus, bond buying, right? They call it quantitative easing. They're cutting that back, and they can sell off some of the bonds that they've purchased, and then the biggest one really is interest rate increases. So as they increase interest rates, the cost goes up for everybody. So if you're using a credit card and you're paying the interest, that gets more expensive. If you're going to go buy a car that you used to get for 1.9% loan and now it's 5.9% loan, less people buy cars. If your mortgages were 2.5 to 3.5% on a house, and now it's 6 or 7, a lot less people buy homes, and homes is a huge economic, boom, because there's so many people involved with building homes and selling homes and what have you. So when that drops down, that takes a piece of the economy, and then companies themselves that do borrow to grow, obviously the cost of borrowing goes up. So the combination of all of these things slows down the economy, which is what they're trying to do. A slower economy would have theoretically less inflation. There's a lot of variables in here, but these are generic terms. And so when you get this scenario where all of a sudden, the economy is slowing down quite a bit, obviously earnings start to fall, and that's the key driver for the stock market. Now, keep in mind that they haven't even raised rates yet. The market's already kind of reacting, getting a little volatile, because the market is a forward-looking mechanism. It's looking, 6 to 24 months down the road and seeing a higher inflationary potential environment or higher interest rate environment that could slow the economy down some. And unfortunately, this is combined in this environment right now with some worry that the Federal Reserve could be fighting inflation that doesn't happen because, say, Omicron comes along, something like that, that slows things down by itself, or the supply chain that is causing so much as inflation now unwinds itself and gets much more efficient again, and all of a sudden inflation comes down. So if you're slowing down an economy that's already going to slow down, you might have some problems there. So that's always an issue too. There's not always the Federal Reserve has been wrong a lot, and so there's some concerns there that they're on going too slow, going too fast. It depends on who you talk to. So that's the big issue with inflation as far as that goes. And we've always had inflation. We had a 12-year run from 2010 to till the pandemic here, and we really had some inflation all the way through there. So lower levels of inflation isn't a big issue. It's just higher levels and especially spiking levels that create the most problem, and maybe just more uncertainty in general as far as that goes. Last piece is that there becomes a competitive asset. So if I can get a treasury bond, I'm making this up, but at 8%, right now the 10-year treasury is at 1.7 something percent. So it's a long ways from that. But if I can get a 10-year treasury that'll pay me 8% a year and the stock market's averaging 11, I have virtually no risk in that treasury and lots of risk in that stock market. So there becomes competitive asset class. So it's a CDs or bonds or treasuries or those types of things start to pay such high rates. Less people will buy stocks in that environment, just because there's other safer places to go to get nearly the same rates of return. We've had just the opposite. One of the reasons I was so positive about this last year being a great year, because there was still nowhere else to go. It was going to be real estate and stocks, right? Because the banks weren't paying anything. That's starting to change this year, in my opinion, at least a little bit. So yeah, that's and then ultimately the Federal Reserve raises rates like we saw prior to 2008. If they overdo it like they did in 2008, we end up with a big, enough slowdown and enough risk being taken, you can have an implosion in the financial system like we did in 2008. So the late cycle tightening is the scariest part to the market. And so that's what's kind of creating some of this, issues right now.
Yeah. So how does that play into a value stock versus a growth stock? Is it should I overweight one of the other over the other based on if I for inflation?
Yeah. Well, first of all, I think it's important to realize that we might not have inflation. So I think a lot of people are marching down the road as if it's a done deal. We've have had inflation. There's a likelihood that we would have inflation, but I'd be very careful about overweighting your portfolio based on what you think might happen with inflation here, and or even you're changing your bond strategy dramatically. I'd still stay very diversified, and we're talking about the little pieces that you might move dealing with inflation. So, for example, in our bond portfolio, our targeted pieces are in these Treasury tips, right? Treasury insured protection securities, um, Treasury inflation protection securities, and so the key there is be a little bit careful. But yeah, altogether, value theoretically does better in an inflationary environment than growth. And the real reason is because value has lower multiple PE ratio. So the price compared to the earnings. So if your price compared to earnings is 9 or 10 versus another company who's at 300, like some of these really high flyer growth stocks, that's why you'll see a lot of those high flyer growth stocks really come down. And it has a lot to do with what they call the discount mechanism. So it gets a little sophisticated, but if the payback period is 300 years and you're discounting back at a higher interest rate, the current value is lower, and there you would adjust theoretically the price, versus a payback period is 10 years. Even at that same interest rate, discounting back to current, there's less impact on the price. And so you'll often see value stocks do better in an inflationary situation. Although last year we saw it kind of like temporary move into the value area, and growth still, especially the big growth stocks, still did well, because it's really, I'm telling you, these companies make hundreds of billions of dollars of cash flow. And so it's hard to beat. That's why I like the Apples and what have you too, even in inflation environment, because the earnings are still so fantastic, especially in a demand environment where we have a lot of excess cash on the sides that are coming in. So